Okay, so let me share my screen. But before I even share my screen, what's your idea of a financial market? Or what's your idea of a market? Let's start from market. What's your idea of a market? From what you know before now, what's your idea of a market? Oh, please, the class shouldn't be quiet too. Or I should mention names.
Okay, please can I try?
Yes, please.
So a market is where a place where people exchange goods or services or products.
Okay, okay. So it's a place where exchange occurs. So one thing is that in the market there's exchange. Okay. More ideas, please. More ideas. At least one more before we continue. Oh, please talk. Eugenia, please say it. Don't say it in the chat. Please say it so that we all hear you, please. Eugenia.
So Eugenia is in a car going home.
Okay. So I'm reading from the chat box. Eugenia said it's a place where buying and selling. It's a place where buying and selling of goods and services occurs. Okay. Okay, that's from Eugenia. So we are also seeing buying and selling, which is another way of saying exchange. All right. So to add to that, once there's buying and selling, it means that there's a buyer and there's a seller. So when we are talking about markets, it means where buyers and sellers meet. Where buyers and sellers meet. It's not just a physical building, it's any place, any space where buyers and sellers are interacting. Okay. So now to bring it to
You are not sharing your screen on.
yeah, I'm now doing that.
Okay, sure.
So our to bring it to our field of financial management, which we are looking at. Financial markets. Once you are dealing with a financial market, we are talking about funds. So far, we've established that once you are talking about financial management, we are talking about funds. We're talking about funds, how funds are raised, how funds are used, how funds are managed. So financial markets is where surplus and deficit units meet to do business. So the whole idea that you should have whilst you are going through financial markets is that there are two categories of people. There are two categories of people. People who have more than enough money, or yeah, who have more than enough money and are willing to spare some. And then those who need money to do their work or need money to generate revenue or to run a business. So on the financial market, these two people meet. These two people meet. So the ones who have more than enough money meet with those who need money, and then the exchange is made on the financial market. When we say those who have more than enough money, it's not in a layman view. Over here, it's trying to say those who have money and are willing to for example, save. Indirectly, once you save, for example, with a bank or financial institution, indirectly, once you save, you are giving the bank a loan. So that's where the rationale comes from, that you have enough money to spare. It's like you are lending money to the bank or to whatever financial institution so that later you come back for it. So you may not need the money at this present moment, but someone else or another organization, another entity needs that money at that moment. But that person cannot come to you. That person cannot come to you or doesn't know you, doesn't know those who have more money to spare. So the financial market is a place where
I mean,
there's
your
exchange.
voice is now from my end. I don't know if it is from my end or your end.
Okay, thanks for drawing my attention. Please, is it same for
Okay,
everybody?
it's okay now. It's okay now.
It's okay. Okay, thank you. Okay, so this is a short overview. We'll go deeper into it of what we are about to do. So financial instruments are traded on financial markets. So we've come to understand that when we are talking about funds or finances or sources of finance in financial management, we are not only looking at money. In the end, it's about money. But then we have the shares, we have and other securities which we'll be looking at. All these are traded on the financial market. So financial markets provide mechanism for individuals and organizations with surplus funds. I've explained the surplus funds. to lend funds to other individuals and organizations that are in need of funds. All right. So the roles of financial markets. So with the little intro I've done, already we can see that the financial market is a place where those who need funds will be able to raise funds. So it's an avenue for raising funds. They collect small savings and pass them to large amounts. So another important thing is that the let's say myself, I have an amount of money and I want to save, and it's about, let's say, 1,000 cedis. That 1,000 cedis is not enough for a business or organization that needs money to run their business. It's not enough. But then, as a result of others who are like me, who are willing or are able to save thousand, the financial market, there are institutions that are able to lump these monies up, and then the company that will now need 100,000 to run business will be able to get 100,000. Meanwhile, if it's up to only me who is willing to lend money, it's only 1,000 I can give. So that's what financial markets do. It's an avenue for raising funds. It also provides liquidity. We mentioned that there are securities that are traded on the financial market. So now a holder of that security who is in need of cash can now resort to the financial market to sell these securities and then convert or liquidate that security to cash in order to do what he or she wants to do. So liquidity is the ease with which financial asset or security can be converted to cash. So how fast it can be converted to cash is liquidity. This is a familiar term which I know we've all met. So borrowing it to this aspect, it's about people having, let's say, for example, a shareholder or an investor who has shares. He or she, as a result of the financial market, can sell those shares and get money if maybe he or she needs money at a certain moment. Then it minimizes transaction cost. Financial markets help keep transaction cost of dealing as low as possible. Financial intermediaries can transact business at lower cost than individuals transacting business on their own due to economies of scale. So we have financial institutions or intermediaries, as our point puts it. We'll look into financial intermediaries. So these institutions, because they deal with providing large amount of funds, the cost they incur to do that is low. The cost they incur to do that is low compared to individuals wanting to lend money on their own, because to lend out money, some transaction cost to be involved. If it's the person, if it may involve transportation, it may involve, even if you are doing it over electronic means, it will involve some charges. But then the banks, because they deal in large sums, they're able to shoulder all these costs. So if it was individual people who are the ones providing the funds, the cost at which they will provide it will be higher, because they also need more interest. But then let's take, for example, me, it's 1,000
I
cedis.
mean, your sound.
Oh, sorry. Let's say it's 1,000 cedis I can give. It's 1,000 cedis I can give as loan to a business. Now that 1,000 cedis, if I'm to charge an interest of 5%, you can calculate how much I'll be getting. Now compare it to a financial institution that has been able to accumulated more funds from different people who are saving, and also charges, let's say, 5%. You see that the amount of interest they'll be getting will be higher. And so, as a result, if it was an individual, he will not charge 5%, he will charge more. But then the financial institutions can easily charge that 5% because they know that they are dealing with large sums. In the end, the interest will be big. So that's under the minimizing transaction cost. Now, to establish fair prices, one of the distinguishing features of a financial market is that it allows for free interaction of demand and supply forces to determine security prices. So in a good market, in an efficient market, there should be fair pricing. Fair pricing here doesn't mean that there's a board or a committee that sets out what a fair price is. No, it's by the forces of demand and supply. The forces of demand and supply on the securities. That's what establishes the price. And that is fair, because it's not having human interferences where someone will take advantage for personal gain, but it's as a result of demand and supply. Then we have diversification. So now on the financial markets, there are different securities. So it gives options. It gives different options to people who want to invest or people who want to acquire one security or the other on the financial market. Now, all the securities, they all come with their different risk. So as a result of having options, these investors or the people or the parties in the financial market can now assess different securities, the risks that come with them, and then diversify. When we say diversify, it comes from diverse. You are splitting your investment into different aspects. Our last sentence is, this is similar to the don't put all your eggs in one basket strategy. So the financial market offers options. In simple and short, it offers options. Now, we have risk shifting. By providing the platform for trading, investors are able to shift risk from one security to another. So maybe as a result of the option, this follows the diversification. As a result of the options that are available on.
Sammy, please check your sound there. Your voice is it's not loud.
Wow.
Yeah.
Okay.
I think it's on and off. Once it comes more, then it comes up as well. So please check it. Or you are using an earpiece.
No, I'm using a headset. Wait a minute. Let me check. Okay, my mic volume.
Okay, sure.
My mic volume is. Please, is it better?
Yes, it's okay. It's okay.
It's okay. Okay. Where was I? Now, risk shifting. I was saying that investors can, if you look at the last statement, another point, investors can make investment decisions such as hold, sell, or buy more of a particular security. Remember, in our earlier, when we were looking at financing decisions, we said that the investment decision is made up of knowing when to enter into an investment, when to sustain an investment, and when to stop an investment. So the financial market gives a number of securities. So if the risk on one security doesn't work in your favor or doesn't work according to the risks that the investor wants, every investor and their risk appetite, some want high risk, some want low risk. So based on the assessment of the security, one can now sell it off in order to do away with the risk and then invest in a lower risk one. That's risk shifting. If it was only one commodity, one security that the financial market gives, or it's difficult to get more options, this risk cannot be easily shifted because the security you get is what you have to stick with, no matter the risk level. Financial markets also provide the avenue for hedging. When we talk about hedging means protection. To hedge is coming from hedge, like hedging is like a wall, putting a wall around something. So to hedge in financial management or in the financial markets as you're looking at means that the investor or the party in the financial market is trying to protect him or herself against unfavorable conditions. Hedging usually deals with maybe interest rates, and then maybe currency rate changes. So with the financial market, if one realizes that the the risks associated with the securities he or she is dealing with is going to be high or will soon be unfavorable, he or she can put in measures to protect him or herself by entering into one transaction or the other. As we go on, we'll see such deals that can be made in the financial field in order to protect oneself against changes in currency, exchange rates, and then changes in interest rates. That's hedging. Financial markets offer participants the opportunity to reduce risks through hedging, which involves taking out a counterbalancing contract to offset existing risks which investors are faced with as a result of previous transactions they have entered to. So hedging is about protection. You're protecting oneself from risk. The financial market gives the
Please, we
opportunity
can't
for
hear
that
you.
to be done. Oh, Solomon, please, is it better now? Is it a line breaking
That's
or
the
there's no sound at all?
the volume is low. It doesn't break, but your volume is very low.
Please, okay. Solomon.
I mean,
Hello, sir.
you have EAP instead of
Yeah, Solomon.
headset.
It's okay now.
It's okay.
Yeah.
All right. Now the last row is arbitrage. Arbitrage is the process of buying a security at a low price in one financial market and simultaneously selling it in another market. So as we go on, we'll see that there are different kind of financial markets, different types of financial markets. We'll classify them very soon. So arbitrage is an advantage to an investor where you can buy one security at a low price in one market, and then on another market, it can be sold at a higher price. This is possible because every market has how it operates regarding time periods, regarding the volume of securities that is traded and all. So arbitrage is made possible when an asset is priced differently. As I said, as a result of different factors, it's priced differently in two different markets. So having realized that an investor can quickly buy in this market and then go and sell in another market. So over there, he has made an easy profit just by buying from one market and selling another market. He has made profits on it. Or it can also happen when two assets of similar risks are priced differently, in the sense that two assets or two financial assets or two securities which are having similar risk in financial markets. What determines price? What determines price? We know that demand and supply determines price. Now, for people to demand it, it depends on the risk. One factor is the risk involved with that financial asset or that security. So the risk that is perceived to be associated with it has a factor to play in the price. So maybe two assets, they have the same risk, but they are priced differently. So one knows that, okay, in this market or in this scenario, this asset having this level of risk is being sold for let's say 100 cities. Now there's a similar asset with similar risk being sold for 50 cities in another market. One can now buy that 50 cities and then now convince another investor dealing in the market that is being sold for 100 that, oh, this security and this security, they're all of the same risk. So buying this one as 100 is the same as buying this one as 100. And then easily you've made a profit on that sale by considering and comparing the risk factors of the two securities. You realize that, oh, they are of similar risk, but one is sold higher. You can buy the one that is sold lower and then sell it for a higher price on the justification that, on the basis that they all have similar risk. Any question up to this point? The rules of financial markets, from the introduction of financial market and the rules of financial market. Any introduction up to this point? Sorry. Any questions up to this point? So we can move on. All right.
Kwame,
Yes, sir.
so let me ask you this question.
Okay.
So with the financial market, is it that we are going there to raise our short-term funds or the long-term funds, or basically it is there for securities purposes?
Okay, so it's there for raising funds, and one which is through the securities. So we are going to soon be looking at the classification of the financial market. And over there, we'll see where we can raise the short-term funds, where you can raise the long-term funds. So it all can be done on the financial market.
Okay, so a sort of we buying and selling something, right?
Yes, please. The buying, so some on the financial market to buy. So those who are buying are more or less putting in the funds for those who now need the funds. So as a result of needing funds, that's why you go to the financial market to sell one security or the other.
Okay, all
So
right,
by
thank you.
selling the funds and then, yes, those buying, you now raise the funds. Yes.
Okay, thank you. Thank you.
All right. So now let's look at participants. Let's look at the participants. Earlier on, when I asked about your idea or some ideas on a market, we all agreed that there's buying and selling. We have buyers and sellers. In our financial markets too, we have the same. We have buyers, we have sellers, and a few others. So we have the lenders, investors, or savers. So they are surplus units who have excess funds to lend, save, or invest. So these people, we can consider them as the buyers because they are putting money into the financial market. Remember, I said that when you are saving with a bank, or you do fixed deposits with a bank, or you buy treasury bills, anything that involves one party putting in money into the financial market, it is taken to mean that you are lending. You are lending money or investing money to that bank or institution or whoever. So that's one party. Then we have the borrowers or issuers. Now these are the ones who are seeking to raise funds. Okay, they are deficit units who are in need of funds and therefore issue securities. So now on the financial market, it looks like it's the inverse. Those who are selling securities, those who are selling, yes, those who are selling securities are the ones in need. They are doing it to raise funds. So they are rather the deficit units who are in need of funds. We see that they are selling because they are in need. They are in need of funds. It's not like they are selling. They are selling their product or their business. No, because they need now to business.
I mean, your network is not stable.
Oh,
It's better now. It's
hello.
better now. Yeah, it's
All
better
right.
now.
So now they are the ones who issue these securities to raise equity or to borrow debt. So now the ones who now come to borrow from financial institutions, or they come to sell securities. For example, their shares. They are the borrowers or issuers. But in this case, they are not borrowing money like going to take money, but they are selling something to get the money. But then the long and short of it is that they are borrowing. Then we now have financial intermediaries. We'll go into more detail on this. But over here, what you are talking about is that when we talk of an intermediary, it means one who stands in the middle of two parties. So the financial institutions are those who they help. The financial intermediaries are those who help the lenders to reach the borrowers. Okay, remember we said that the financial market is an avenue for raising funds because it's able to lump all the money from the lenders, investors, or savers for the borrowers or the issuers to be able to get the money to do one business or the other. So they are the institutions that assist in the process of transferring funds from the surplus units. Surplus units is the term for the lenders, investors, or savers. They transfer from surplus units to the deficit unit. So examples are banks, savings and loans, companies, credit unions, and what have you. Now we have the regulators. The regulators. Even in our markets, for example, local markets, we know there are people in charge who regulate how things are done, who are in charge of the stores, who are in charge of how the market is run in an orderly manner. Same on the financial market. We have institutions in place. And I recall when we were looking at the environment of financial management, we saw the regulatory environment where we saw the different sectors and the different regulatory bodies in charge. So these are also parties on the financial market. They are the governments and government institutions that regulate the financial market. So we saw that in the banking sector, for example, in Ghana, in the banking sector, we have the Bank of Ghana that regulate things that happen there. We have the National Insurance Commission that regulates the insurance field or the insurance sector under the financial sector. We have the National Pension Regulation Authority. So these are the regulators. They are there to make sure that rules are played by. Then we have the international institutions or the supranational institutions. They are the ones that are beyond the country. So all the examples I mentioned were within the country. The Bank of Ghana, National Insurance Commission, and what have you. But then beyond them, there are now the international bodies like the World Bank, IMF, and African Development Bank. They manage the international financial market. So it tells you that in Ghana, we have a financial market. An example could be the Ghana Stock Exchange. But then on an international scale, there's the international financial market, or there are international financial markets, which are now regulated by international bodies like the World Bank, the IMF, and the ADB, as you've seen. We are moving on to the various classifications of financial markets. So in classifying financial markets, you can classify them under capital and money market, primary and secondary market, then exchange traded, that's the organized market, or the over the counter market. Now the capital market. I recall we addressed the question about whether financial markets are for long and short-term sources of finance. So over here, it's addressed by this classification. Capital markets are the markets for trading in long-term finance. As the name suggests, capital. As the name suggests, capital. So we are talking about long-term funds over here. So long-term, so in the form of long-term financial instruments such as equities, that's equity shares, and corporate bonds. Long-term securities have a maturity period of more than 1 year. Remember, in our field, once you are talking about long-term, we are talking of something that exceeds 1 year, that exceeds 12 months. That's long in financial and in accounting language. Once you say long-term, we are looking at more than 1 year. So capital markets are both national and international. The capital markets can be classified into equity and bond markets. So the idea is the capital market is where remember we saw borrowers or issuers. So borrowers or issuers are the ones who want to raise funds. So now when they want to raise long-term funds, they come to the capital market for long-term funds. So now we are dealing with huge sums, and the purpose is to run or for capital expenditure. For capital expenditure, that's expenditures or investments that span more than 1 year. So to fund such an investment, the appropriate or the matching source of funds is long-term funds, and that can be found on the capital market. So on the capital market, we have equity and we have bonds. Equity is about shares. So it's a marketplace for buying and selling shares in companies that apply to have their shares traded or traded on the exchange and whose application is accepted. So in our previous meeting, we saw the Ghana Stock Exchange and then the various listings they offer, the requirements and all that. So that's for equity market. Then we have the bond market. The bond trades debt instruments. So when you talk of debt instruments, it means that when the lenders, investors or savers buy or invest in the debt instruments, it means the organization or the institution or the borrower or issuer who issued that debt instrument now is owing the one who invested in it. So a market where debt instruments are issued by the government agencies, international organizations, and companies. So where debt instruments are traded is the bond market. And that name for bond is debt. When I'm talking about bond, we're talking about debt. It's just like a loan. It's just like a loan. Most bonds are issued for a fixed period of time. That's after the time elapses, it matures. When we say matures means it has reached a time when payments of principal should be made. That's the maturity date or the maturity time. Types of bond include government bond, corporate bond, municipal bond, and international bonds. Now we are moving to the money market. But any question on the capital market or anything we've done up to this point? Questions? Any questions? Any questions? Please alert me if I'm moving too fast also. Okay, let's make progress. Money markets. So now, based on the classification,
So in summary, you said in terms of reclassifying our financial market, we have the capital market and then the money market, right? So short, I can say that the capital market is for long term, and then the long term takes into consideration the equity and bond. So here,
yeah,
if I have the idea that is coming from sources of fund, it means that automatically I'm supposed to refer that side to what the capital market, right?
yes, once it's long term.
Okay, once it's long term. Okay, thank you. Okay.
Please, any question? Or we are all good?
Mr. Ato, Sammy, you can also be mentioning their names if they have questions. Mr. Ato, any question?
No, please, for now.
Okay.
All right. As we move on, I'll be asking questions from what we've done from the beginning to wherever we reach. So once you have no questions, I'm assuming we are all following, we are all understanding, and we are all remembering. Like I said, if I'm moving too fast, please draw my attention. But we'll finish. We'll finish this note for today. Okay. Money markets. They are markets for trading short-term financial instruments and short-term lending and borrowing. This form of financial market deals in relatively short-dated funds and is operated by the banks. So now, per the classification, we have capital and money market. So once capital is long-term, money markets are dealing with short-term financial instruments. This form of financial market deals in relatively short-dated funds. Yes, relatively short-dated funds, and is operated by banks and other financial institutions as well as government. So an example is treasury bill, repurchase agreements, commercial paper, negotiable certificates of deposits, which we'll be looking at. So now the main underlying factor is once long term, we have established that long term is 12 months plus, short term is within or less than 12 months. We said that once we are talking about long term, the instruments have a maturity date. Maturity date means the date or time where the borrower or issuer, would have to make payments of the principal that the lender or investor lended or invested in the security. So now money market is where this payment or this maturity happens in less than a year. So an example is treasury bill. Treasury bill, we know we have I think 91 days. And 91 days is a short period per our definition of short term. So the main money markets are interbank markets and the repo market. The interbank market is a bank for borrowing and lending large amounts of money for a short term. So with this one, it's not necessarily about the amount of money or how big the money is. What distinguishes capital market from money market is the time frame. Is the time frame. The time frame when maturity, the time frame to maturity. Yes, the time frame to maturity. So it may be the same amount, let's say 100,000. It's something you may get on the capital market and also may get on the money market. But then on the money market, that 100,000, that for example, you've invested in treasury bills, the maturity is less than a year as compared to capital markets where maybe the 100,000 borrowed would have to be paid within, let's say, 2 years, 3 years, and so on. So the interbank market is a bank for borrowing and lending large amounts of money for a short term, often overnight, for one day. So that same amount of money, but in the money market, more specifically in the interbank market, it can be borrowed, but it has to be paid depending on the terms. For example, overnight or in one day. So it's from one day up to 1 year. From one day up to 1 year. That's the time frame. It is mainly a market for borrowing or lending between banks, but companies are able to participate directly or through their bank. So mostly it's banks. For example, banks need an amount of money, or they need huge sums of money to carry on their business, because they are receiving deposits and then people are also making withdrawals. So money is coming in, money is going out. So at least there should be an amount of money there, so that should in case the withdrawals are more than the deposits, they wouldn't be stranded. So it gets to the point where banks may have to resort to their fellow bank or another bank to loan them some amount of money, maybe to do business for the day or for a certain time, and then we'll have to pay back. That's why it's called interbank. But then, per our notes, it's telling us that it's not restricted to only banks. Companies can also do that kind of a transaction, or that kind of raising of funds. They can do it directly, or they can do it through their bank. So their bank could front for them, and then meanwhile it is for the company, and then the company pays to the bank, and then the bank does the payment. Now, a repo market. A repo is a sale and repurchase transaction. So in the repo, there's a sale. There's a sale. But then once the sale is made, so for example, A sells to B, but the agreement is that A sells to B, but the agreement is that A will buy it back from B at a higher price. At a higher price. So it's just like B giving A money, and A will give the money back to a higher amount to B. Just that this one, there's a purchase, a purchase. So it's a sale and repurchase. So A sells to B and then purchases back from B, but that's a higher price. Where one party sells a quantity of short-dated bonds, remember the timeline within 1 year, or money market security to other party, and at the same time undertakes to buy them back at a specified future date at a higher price. But remember, it's within 1 year. It's within 1 year. So now some money market instruments. We're looking at some money market instruments. So we've looked at repurchase agreements. Before already looked at it's an instrument, repurchase agreement. So the repurchase agreement, it happens in the repo market. So in the repo market, repurchase agreements are made, or the repurchase agreement instruments are sold in that market. So very quickly, somebody to tell us what a repurchase agreement, the instruments, what does it mean? Very quickly, from what I just said about the repo market, what will be the repurchase agreement? Or what is the repurchase agreement? I've basically said it just now. Francis.
I'm still at the office. Let me reposition myself so that I can talk.
All right. Kingsley. From what I just said, repurchase agreement. Just repeat it back for me, and let's continue. Oh, no responses. Kingsley. All right, let's continue. So repurchase agreement, like I said, is a sale. It's a sale and repurchase. So A sells the security to B, and then A will agree that you buy it back from B at a higher price. So thereby B is getting back the money plus a form of interest. A form of interest. So next is the certificate of deposit. So with the certificate of deposit, it's a certificate of receipt. Okay, it's a receipt for funds deposited at the bank. So you've deposited an amount at the bank, and the bank gives you a certificate to show that indeed you've deposited an amount at the bank or any other financial institution for a specified time. Remember, these are examples of money market instruments. So once you're talking about time, it's within 1 year. It's within 1 year. and then the bank will now pay you interest on that deposit. So this one is a common thing. But then the instrument that shows that you've made the deposit is what we are calling the certificate of deposit. It's just like a fixed deposit. But what shows, or the certificates that shows that you've actually made the deposit and then going to be paid the interest at the future date. Sorry, at a specified rate, at a certain rate, is the certificate of deposit. Now we are going to discount instruments. So treasury bill. So treasury bill are issued by the government. Yeah.
The certificate of deposit,
Okay.
is it the same as fixed deposit or time
Please come
deposit?
again. Please come again.
I am asking that with the certificate of deposit,
Okay.
is it the same as fixed deposit or time deposit or something like that?
Time deposit. Please, what do you mean by
Fixed
time deposit?
deposit, commonly called
Please,
fixed deposit, is it the same?
you mean time deposit and fixed deposit are the same? I'm not getting what you mean by time deposit. That's what I'm asking.
Hello.
Yes, sir.
So I am asking that the certificate of deposit, is it
Yeah.
the same as fixed deposit?
Yeah. So the certificate of deposit is like the evidence that you've done a fixed deposit.
Oh, okay.
Is are you getting it? Over here, we're
Okay,
looking at
sir.
the instrument. So the certificate of deposit is what the bank gives to you. So that's the instrument
Okay.
that you now hold to show that indeed you've done the fixed deposit with the bank.
Oh, okay. Oh,
Please,
okay,
I hope you
okay.
get it.
Yes, sir.
Okay. So now with treasury bills are issued by our government, and they are within, like, if established within a year, sometimes 91 days, sometimes a number of months, sometimes a year, depending on the terms the investor, the one investing, depending on the choice of the one investing. Yeah. So the treasury bill is more like you are giving a loan to the government. So they don't pay interest, but are issued as discount. So with the treasury bill, they are issued at a discount, which means that they don't necessarily pay an interest on them, though you can calculate and see the effective interest rate that is being paid. But in actual essence, the treasury bill, let's say the treasury bill costs 1 million, it will be sold or issued at a discount, but then upon maturity you get the 1 million. So the difference between how much you bought it and then the value at par, or the face value, that's what now becomes the interest that you've got on that treasury bill investment you've done. Please, I hope you get it. And this one is the government. You are doing it with the government. It's government treasury bill. So you know, with this one, the risks are very, 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 very minimal. Please, do you get it?
Yes, sir.
Okay, so now we have bankers acceptance. So with the bankers acceptance is where it's an order. For example, company A deals with GCB Bank. So company A is going to enter into a certain contract. So he or she, instead of paying immediately, they will now give an order that there should be a payment made to the bearer, or to the one that he's entering into the contract with. So company A is entering into a contract with company B. The banker's acceptance is an order for company B to be paid a certain amount at a future date. So company B, though is not receiving money at the current moment, but he's holding the banker's acceptance. So he knows that in a month's time or in 2 months' time, he can walk to company A's bank, and then that banker's acceptance, when showed or presented, is the order that he or she holding that banker's acceptance should be paid that amount which was agreed in the contract. Please, do you understand? All these, you see, I'm explaining it in terms of the agreement, but then the terms over here refer to the paper evidence or the evidence that one holds. You get it? The evidence one holds or the instrument. That's why they are called instruments. Please, do we get it?
Yes, sir.
So in this one, company A and company B have entered into that agreement. But now what company B holds to go to the bank for that order to be carried out is what is called the banker's acceptance. And then lastly, we'll look at the commercial paper. For the derivatives, I will not say them for now. You may go and read on them or search on them. I'll not say them for now, but we'll meet them when we are looking at financial risk management. We'll see forward and future, swaps and options. So I'll hold on that one for now. When we get there, I'll refer you back that we mentioned it here. Then we'll look at it. So let's look at commercial paper. So with a commercial paper, it's an unsecured promissory note. So it's a promissory note that is not binded or secured with a collateral or any asset. But then this one can only be issued by firms that are reputable. So for example, you are dealing with let's say you're dealing with Nestle. You're dealing with Nestle. You know, Nestle is a reputable firm. So they may buy some things or enter into some contract, let's say some importations for some raw materials. They may not pay at the instant or at that time. They can issue a commercial paper. That's a promissory note. Okay, so on that note, with whatever relevance or required stamp on it or signatory on it, it's a promissory note that the amount of money will be paid at a certain time. So that one too is an instrument. Do you know that all these instruments are instruments that can be sold? That's one thing you should bear in mind. It can be sold. So I hold a commercial paper. Nestle Ghana is supposed to give me that amount of money in 1 month's time, or per the agreement in at one point or the other. I can now sell it to somebody who maybe I'm owing, or maybe I need to make a transaction. And I tell the person that, you know what, I'm having this commercial paper from Nestle Ghana. They're supposed to pay me this amount. You take it. So that the amount, when the amount is paid, it comes to you. So all these things can be traded. That's one thing you should bear in mind. It can be traded. It can be, there are papers, there are documents, there are evidences that show agreement, and then they can be traded. Please, any question? Any question? This concludes money markets and capital markets. That's the first classification. We are moving on to the next classification. All right, to primary and secondary markets. Primary markets enable organizations to raise new funds. So this one we are looking at the, should I call it the timing? I'm looking at the, yeah. Primary markets enable organizations to raise new finance by issuing new shares or bonds. So with this one, it refers to issuers. It refers to issuers or borrowers who are raising funds for the first time or raising new funds. Not for the first time, but they are raising new funds. Maybe a company wants to raise more share capital or they issue new shares or new bonds. They go to a primary market. It's a market where new securities are issued for the first time. Okay, for the first time. Issue of securities in the primary market can take the form of private placement or public offering. From our last class, who remembers? We said that securities or shares can be sold privately or publicly. I hope you all remember. So on the primary market, that's where shares or bonds are sold or issued. New shares or new bonds are issued. So they are being issued by the company. So a company is now sharing. So for example, let's say Nestle Gala is issuing shares. So as they are issuing the shares from the company for that first time, it's from Nestle Ghana. So it's a primary market. But now if somebody now holds the instrument, that's already, because so before now, the underlying thing is that before now, that share was not in existence. That share wasn't there. It's now being issued. It's now being introduced to the market. So after it's introduced to the market and it's on the market, there's a existing market for it. And then somebody who is holding that Nestle Ghana share now wants to sell it to another party. In this case, the shares have already been issued. The market is already existing. That now becomes the secondary market. That now becomes the secondary market. So that's primary and secondary markets. Now we're moving on to the next classification, which is exchange traded and over the counter market. Exchange traded and over the counter market. So with the exchange traded, we are looking at organized markets, markets that are organized, even in the normal commodities, or when we are talking about commodities, we have shops. We have shops, or we have a central point where it is sold, a place where you can go and sell it. That's organized. It's organized. Then we also have the other side, which is it's not a specified place, but then you can do it on an online. You can do it on an online platform, for instance. Do it on an online platform, for instance. So with that one, it's not really regulated compared to those who are doing it in the organized markets. That's one of the main differences. Let's read what we have. These are markets with a comprehensive regulatory framework of traders linked to one platform. They can easily be located because they have a trading floor, that's location, or electronic platform. So there's an electronic platform, a central one. They are all linked to it. All the traders are linked to that market, where only authorized members can trade in the securities listed. In other words, there's a central location on an electronic platform where buyers and sellers securities meet to trade. So with this one, it's centralized and it's highly regulated. There's a framework that governs everything that is done. So this one is formal. An example is the London Stock Exchange, Ghana Stock Exchange. So most of the stock exchange, securities exchange market, those markets are organized markets because it's formal and there are laws that govern everything. Then you have the over the counter. It's largely unregulated, so it's the inverse, whereby geographically dispersed traders who are linked to one another via telecommunication system and computers. So in this case too, there is like I said, the online space where things are done. But the difference here is that they are not all on one electronic platform. They are all dispersed. In the over the counter market, transactions do not involve buying and selling through an exchange, but customers negotiate individual transactions. So every transaction differs from the next transaction depending on the negotiation and the deal that is arrived at. But for the organized market, everything is formal. It's just like how you can go into some markets to buy certain commodities and you can bargain, but then you enter into another place, it could even be the same commodity, but you can't bargain because over there prices are tagged and everything. It will be very odd if you go and then you bargain. So in the same way, the organized markets, everything is formal. If there's the share price, if there's the prevailing share price, that's the share price. If there's the price of the security, that's the price of security. But in the over the counter, it's individualized. So based on the negotiations between the borrowers and the investors or the lenders, depending on the negotiation, then the price is determined and then the various terms are determined. In over the counter market, transactions do not involve buying and selling through an exchange, but customers negotiate individual transactions, usually with a financial intermediary such as a bank. Securities that are issued in an over the counter market can be negotiable or non-negotiable. So when we say negotiable, it means they can be resold. When we say non-negotiable, it means they cannot be resold. So with the negotiable, it means that, remember this one, there's individualized transaction. So the terms that you got and the way you're able to get it in the over-the-counter market, in some cases it can be resold, but in some cases too, it's such that you cannot resell it because it is peculiar to individual transactions. I hope you're all on the same page. Okay, so on other class, these are the main classifications, what we've looked at. But other classification, we have the dealers market and the auction market. In the dealers market, the buyers and the sellers, they negotiate, come to understanding, come to a price, they determine the terms and everything. The borrower or the issuer, and then the lenders or the investors, they negotiate. But in the auction market, it's about bidding. It's about bidding. So sometimes shares can be issued in that way, where the people who have higher to offer are the ones who are able to buy it. So they are not sold through normal negotiation, but through bidding, where the various parties who are willing to invest must bid. And then the one who is able to make the best offer, or the ones who are able to make the best offers, are the ones who are able to buy in such market. Any question up to this point? Let's pause and take questions. If you do not have questions, I'm going to ask questions one by one. I think except Eugenia, who is in a car, I'm sure we can all talk. If you do not have questions, then I have questions one after the other for everyone. Can I bring up my questions, please? Any questions, or I should start with my questions? Okay. Kingsley. Hello, Kingsley. Please, are you with us? Okay. Mabel. Hello, Madam Mabel.
Yes, hello.
Yeah. Okay. So, can you please give us one rule of financial markets? You give us and explain one rule of financial markets.
So please, financial markets are to we use financial markets to raise funds, right?
Okay, they serve as an
So
avenue to raise funds. Okay.
yes. So for example, you can issue shares. A company that needs funds, capital for their operations can sell shares on on the financial markets, namely the capital markets, to raise funds for their
All right. All right.
operations.
I like how you linked it to the capital markets. That's good. Okay. Kentola. Kentola, can you also give us one rule? One rule of financial market. Financial markets. Sorry. Hello, Kentola, are you with us? Okay, Solomon. Solomon, one rule of financial markets.
Please, can you hear me?
Yes, Senior, we can hear you.
Um, Financial instruments can be traded.
Okay, so we established that financial markets is a place where instruments and securities are traded. But we want securities, more specific rules of financial markets. As they are trading, what do they do in that trading? What do they do? We saw that through that trading, Madam Mabel was able to tell us that through that trading, there are companies or some parties are able to raise
So
funds.
the yes, please.
Yeah, so please give us one also.
What were the participants?
Please come again.
Are you talking about the participants?
No, please, the rules. Financial markets, what do they do? Their
So
functions.
I said itself.
Yeah, Solomon, we are with you.
Okay. The participants, financial intermediaries, and the rest, they may not have that opportunity to trade these financial instruments. So with the what do you call the categories? We have the, what do you call it, and the rest. All these kind of financial instruments cannot be what traded. So it is a rule that they play.
All right,
I don't
all
know
right.
if you get what I'm saying.
So yeah, I get you. So we'll say that we'll link it to the aspects or the role of financial markets having options, where the parties have options. There are different securities on sale, which they have access or they have the option to invest in or not. All right, Mr. Francis, please can you talk now?
It's like the network.
Oh, okay, okay. Please, I can you all hear me, please?
Yes, sir.
Yeah, Mr. Francis. Can you please give us some participants in the financial market? We looked at about 4 or 5 participants. Can you please mention some of these participants for us?
Hello, sir.
Yeah,
Sir, your question again.
some participants in the financial market. Participants. We looked at about 4 or 5 of them.
Participant.
Yes, sir.
Okay, banks.
Banks. Okay. What did they do?
They they provide capital for transactions.
All right. But we looked at how they do that. How did they do that? Do they just generate money, or they just generate money and give, or the fund they just generate it themselves and give? We looked at something that the banks do as
Okay.
participants on
In
the
fact, I
financial
miss
market.
I miss that area. But so
Oh,
what?
okay,
Good evening. So what I can say is that
okay,
they take deposit from customers
very good,
and also provide it in the form of loans
very good, exactly, exactly.
to people who need it.
Who need it? Exactly. So the term we used over there is that they are financial intermediaries. They serve as the one between those who save, those who save or those who deposit with them, and the ones who need funds or who need capital. So that's what the banks do. That's very good.
Okay. Okay.
Romance. Romance construction. Forgive me.
Hello.
Forgive me. Yeah. Uh,
Yeah.
please, your name is Romance that is showing here. So that's what I'm saying, Romance. If you
My
could please
name
help
is
us with
Robert
your name.
Spencer.
Okay, Romance. Okay, Robert Spencer. Robert
Yeah.
Spencer. Okay, Robert Spencer. Can you also give us one more participant in the financial market?
Yeah. One is the household. That's the individuals.
The individuals. Okay, what do individuals do on the financial market?
Yeah. For them, they save and invest money
Exactly,
by
exactly. So
buying the shares and treasure bills and
exactly, exactly. That's good. So these individuals and households are examples of the lenders or investors. So they are the
yeah.
investors and they are the very good, very good. All right. I think we are all on track.
Okay.
Hello, Kingsley. Kingsley, are you with us now? Hello, Kingsley. Are you with us now? Seems Kingsley is not with us. Okay. Eugenia said she's in a car. Okay. So let's move on. Financial intermediation. Okay, I just saw in the chat box, Eugenia wrote enable risk management. That's very true. So we explained that as a result of the options that are available, the investors can invest in different securities, and they can also do what we call hedging to protect themselves from any future unfavorable changes. Okay, so we looked at risk management on the financial market. Okay, let's move on. So financial intermediation. So we've already come across the term the financial intermediaries. So we are coming to look at the process or what financial intermediaries do. That's what we call financial intermediation. So already we have a fair idea that the financial intermediaries are the ones who transfer the funds from the lenders or investors to the borrowers or the issuers. Okay. So it's a process of transferring funds from surplus unit to deficit unit. When we say surplus units, Solomon, surplus units, we said surplus units are which people? On the financial market, which people are the surplus units? Yeah, Solomon, we have two. Surplus unit.
Those who Please, can you hear me?
Yes, I can hear you. You said those
I'm
who
saying who has excess fund. Those who have excess fund.
exactly those who have excess funds and they can invest, they can save. Those are the surplus units. And then the deficit units is the
Yes,
other side, those the borrowers or the issuers
yes.
who are there to raise funds. Exactly. Okay. So the financial intermediation is the process whereby or through which the funds are transferred from the surplus unit to the deficit unit. So they are like the middlemen who bring users of funds and providers of funds together. Participants in financial market normally enter a financial market indirectly through the intermediaries. So in entering the financial market, most of the time, the issuers or the borrowers are not in contact with the lenders themselves. For example, those who do the savings. They are not in contact with those who do the savings themselves. So though they are all participants on the financial market, it's not like the issuers go to the borrowers. So it goes to the lenders directly. It's not always the case. Like how maybe in our normal market setting, money is given and a commodity is taken. But on the financial market, majority of the transactions occur through financial intermediaries, mostly the banks. So even shares, some companies issue their shares through the banks. Banks sell it for them. You get it? Getting of loans is through the banks. They get it from the banks, but the banks are not actually the ones who are generating the funds. But then they are getting it from people who are saving and keeping deposits with them. So that's financial intermediation. There are two main types of financial intermediaries. We have, we have the depository and the non-depository. Now, when we talk about the depository, we are talking of those who receive deposits, like the banks. So the banks, they keep deposits. They keep money in accounts, maybe savings account, fixed deposit account. They keep such monies, and then when the borrowers or issuers need the money, the borrowers come and they're able to secure, let's say, loans. Then we have the non-depository. So with these ones, though they also receive money or get money from the investors or the lenders, they are not like deposits. A classical example is the insurance companies. Insurance companies get money from those who do insurance, but then it's not like those who pay the insurance premiums have an account or deposits with the insurance company. Please, I hope you are getting it. It's not like they have an account with them. So they do not keep, they don't necessarily keep deposits. We also have intermediaries that are, we call them the stockbrokers. They do not keep deposits, but then they're able to help people who are selling shares to sell, and then people who are buying shares to buy. So that's also another aspect. So the depository and the non-depository. The depository, there are those who keep deposits from from the lenders or investors. So they are the ones who can give loans. They're the ones who can give loans. But the non-depository, they do not give loans. In a normal case, they do not give loans. They are more involved in the other securities, the other instruments. I hope it's clear. Financial intermediation, financial intermediaries, and then the depository and the non-depository. I hope it's clear. All right. What are the functions? Before we go down, let's discuss. What do you think are some functions? Looking at what we've done or what we said, very quickly, let's mention some functions. Solomon, can you start for us? Some functions. From what we've just done, what in your understanding, what do financial intermediaries do? Or what is the rule? What is the importance of financial intermediation? Intermediation. Solomon, please are you with us?
Yes, please.
Okay.
Um,
Okay.
let's say provision of fund from the surplus unit to the deficit unit.
Exactly. So with this one, you can even borrow it from financial markets. So in the financial market, we said that it's an avenue for raising funds. So the financial intermediaries are one of the parties who help in raising the funds because they're able to connect the lenders to the borrowers or the issuers. That's very good. Okay, any other one? I think this is the straightforward function. So if any for nothing at all, we should all remember this function because it's embedded in the definition, in the description that we've given. So let's look at some others. They provide obvious and convenient ways in which a lender can save money. Instead of having to find a suitable borrower for their money, the lender can deposit their money with a financial intermediary. So instead of finding somebody who is willing to take the loan from you and then pay that interest, the lender can easily save that money with the financial intermediaries, knowing that the financial intermediary is going to work with that money, give it out for loans, and then get interest. And now there's the one who is saving or the lender can later on go for that money. You get it? So it's convenient compared to looking for somebody to take that money or for you to loan that money to who will now be willing to pay back at an interest rate. So it provides obvious and convenient ways in which a lender can save money. Then financial instruments also provide a ready source of funds for borrowers. So borrowers are not too much disturbed or they don't go through too much stress. For example, in the raising of shares because a financial in the issue of shares because financial markets exist or financial intermediaries exist. Sorry, financial intermediaries exist. So some financial intermediaries are there, for instance, to buy the shares. They can buy the shares and then they will also go and sell it on the financial markets or to shareholders. So in that case, the one who wants the funds, the borrower who wants the funds, readily has somebody to buy it, readily has somebody to buy the shares. I hope you get it. The one who has the debt instrument or the equity instrument readily has a market for it. And so he can raise funds quickly once he's able to sell on the financial through the financial intermediaries. Because some of the financial intermediaries, for example, the banks, they have a reputation. They have a reputation for themselves. So once you're able to sell your shares or issue your shares through such a financial intermediary, which is that bank, you're able to quickly attract shareholders because they know that if this bank is willing to be involved or issue shares for this upcoming company or for this company, then there's that trust. I hope you get it. So it provides a ready source of funds. Even when money is in short supply, a borrower will usually find a financial intermediary prepared to lend some. On the other hand, too, the borrower can easily get loans. So even when money is short in supply, as our point has said, the borrower knows that he or she can get to the bank, fulfill the necessary requirements, and will be able to get a loan. Another point is that they can aggregate small savings deposited by savers and lend on to borrowers in larger amounts. So now it's not just about taking the loan or a ready source of funds being available, but the amount is very important. So you may need up to a tune of 100,000, Financial intermediaries are there to aggregate the small chunks that the investors or savers or lenders deposit or save with them, and then now be able to redistribute or give it to the one who needs that huge amount. So the emphasis on the aggregation, they're able to aggregate the smaller savings deposited by savers and lend on to borrowers. Now, financial intermediaries, most importantly, provide maturity transformation. Once you're talking about maturity, we've established that when we're talking about maturity, you're talking about a time when a given amount is supposed to be paid back. Okay, so now the idea here is that a company needs money for long-term purposes. For long-term purposes. That's the maturity in the sense of the company. But the one who is investing or the one who is lending or saving needs the money, may need the money in a shorter time, but at the moment he doesn't need the money. So that he may need the money in 2 months' time. So he's able to, if he saves the money now, the financial intermediary is able to work with that money, and within that 2 months' time, which is the maturity, he's able to give the money back to the one who paid, who lended or who saved. Then at the same time, it has been able to transform that person's maturity into another long-term maturity. Now the bank, as a result of the one who lended or the one who invested, as a result of his action to lend or to save, the bank has now been able to get money to be able to expect an amount in the future. I don't know if it's clear. So this, for a number of individuals, will need an amount of, or will not need an amount of money now, but they will need it in maybe 6 months' time. The bank can use that 6 months to aggregate, or the money that is aggregated from these people, he can now work, the bank can now work with that money, give it out to others for, let's say, longer term, let's say 2 years. Let's say all the money summed up together will be 200,000, 200,000 Ghana cedis. That 200,000 Ghana cedis can now be given as a loan or loans to companies or a company, and which the bank will receive in 2 months' time. In 2 years' time. But then within now to that 6 months, you see that the company will have to be paying some interest. So now those interest payments can be used to pay back people who may now need their money within the 6 month time. And then now the bank or the financial intermediary now can expect that in 2 years' time, 200,000 will be paid to the bank. I hope you get it. So it has been able to get its own money. The financial intermediaries is able to transform that short-term maturity which the holder of that fund had in mind into a longer term one for itself or for another company that needs funds. Please, is it clear? Please, is it clear? Any questions on that? Please,
Okay,
yeah,
so please, I want to
okay.
ask.
Okay, I'm listening.
So who pay the intermediaries?
Who pays the intermediaries? Your question is who pays the intermediaries?
Yes, please.
Okay.
Who pay them?
Then,
Because
I'm listening. You said because Solomon.
hello. Yes, sir.
Yeah, you said because you didn't finish your. I didn't hear the full statement.
It's
You said
like
because
they more. I'm saying that who pays them because it's like they are agents and they act between what do you call it, the lenders and the borrowers. So in this case, who pay them? Is it the surplus unit or
okay. So with this one,
the deficit
they are
unit?
not
Who pays them?
okay. So with this one, they are not necessarily paid because it's not like
Okay.
it's not naturally like an agent's principal relationship. Okay, it's not naturally like that. But then the financial intermediaries, what they gain from is the interest that they now accumulate from the loans they give out. I hope you get it. So let's say they give out, they're able to aggregate there's other people's savings, and then the savings or the deposit at a rate of, let's say, 15%. The bank will now give that amount as a loan at a rate of 20, let's say 20%. Okay. Now 20% on that aggregated sum.
Okay.
After
Okay.
they get that money plus the 20%, they can now also give back the those who saved, the lenders, their money with the 15%. And then the one on top, the 5%, is now for the financial intermediary. I hope you get it. So the financial intermediary, it is just transferring the funds from the savers or the lenders to the borrowers. Then when the savers or the lenders or the investors need it, they're able to give it back to them at whatever agreed interest rate. Then once they give it to the borrowers, also pay back to the financial intermediary. So it's like a chain. It's like a chain, like a cycle. They give it from those who are willing to save to those who are needing it. And then by the time the people who need it are paying back, as they pay back, the bank can also give back to those who saved when they need it. And then whatever surplus as a result of
Okay.
the added interest is to the financial intermediary.
Okay.
You can come in.
So please, can you give me one example of the financial intermediaries? One example.
Oh, financial intermediary. Oh, I can say the banks, the commercial banks,
Okay. Okay, sir. Thank you.
the micro credits, all such institutions, they are intermediaries.
So what about the insurance companies?
Come again.
What about the insurance companies?
Yeah, insurance companies also act as intermediaries because they work with the money so that when you need it, in the event that one person needs it. So let's say the your premium you pay, the premium you pay is not always actually enough for when, let's say, for example, an accident occurs. When an accident occurs and then your car has to be replaced for you, for instance, the amount of premium you actually pay is not up to that amount. But because others also pay the premium, they are able to serve you at that time. I hope you get it. They're able to serve you at that time. So they work with the
But
money, the premium. Yeah, okay. I'm listening.
so do they also give money to individuals like the banks do in the form of loans?
Oh no, no. Insurance companies do not do that. They work with the money. They do investments with the money and whatever their course of business, so that whenever the money is needed, they'll be able to, per the terms of the insurance contracts, they'll be able to help the person who did the insurance with them.
So,
But there are some insurance companies who give loans. Yeah, somebody was talking.
so, so I wanted to say that one, but you have said it.
Okay.
Insurance,
But
some
then,
of them give loans.
yeah, so that one is an addition to their what they do. But then if you're talking about insurance is about you are paying premium against an unforeseen risk. When the so-called accident that is being insured against occurs, when it occurs, or if it occurs, the insurance companies come to your aid. You get it? But then some of them, in addition to the insurance, they add credits or microfinance where they give small loans. That one is an added feature. But if you're talking about pure insurance, it's not loan. Are we all on the same page?
Yes, sir.
All right, thank you. Efficient market hypothesis. So we are come to look at what is an efficient market. We are come to look at all the markets we've looked at. We are come to look at in which instances can we say that they are efficient. So an efficient market is a market where prices fully and instantaneously reflect all available information. So in an efficient market, the prices are reflecting the available information. For instance, a car being sold in a let's say in an efficient market where cars are sold, a car being sold, the price of the car should fully reflect the state of the car, all information about the car, the condition of its engine, the condition of the body, the condition of the interior, everything. So where the price is not fully reflecting that information, maybe because some information is hidden, or the one who is selling didn't say the full story, then there's no efficiency. In efficient market, prices fully and instantaneously reflect all available information. I think you recall where we said that some financial securities can be sold differently, the same one sold differently, different prices on at different markets. This could be some of the reasons. Maybe in another market, information is not fully, the price does not fully reflect the information. So somebody seeing that can quickly take advantage and sell in that financial market at a higher price. But in an efficient market, the price should reflect the available information. When we are talking about information, we're talking about the risk, the nature of the security, and everything has to do with the security. The price should reflect it. That when somebody pays or invests in that security on the market, he or she is getting the money's worth. In an efficient market, prices accurately and rapidly adjust to reflect the true intrinsic value of securities. That's why, for those who are into trading and these stocks, and yeah, those who are into that, you see that some share prices drop on the stock market. They drop, they rise, they drop, they rise, they drop, they rise. You see it on some charts and some graph. They drop and they rise. So that's showing the efficiency of the market. That once there are changes, while there are changes in how the company is performing, in how the security is performing, automatically the price should also change to reflect that value. It's important to note that the more efficient the market is, the less the opportunity to make speculative profits. Remember I said that. I said that when an asset is sold differently, sold at different prices, one can make speculative profit, in the sense that because at one side information, there's no full information about the asset, he can go and sell it at a higher price. So in that case, he's making speculative profit. He bought it and then went to sell it to those who do not have enough information at a higher price, because on that side it's being sold at a higher price. But where the market is efficient, those people are aware, they have the information that this is what the security or instrument is worth. Therefore, they will not be willing to pay that higher price for any speculative profit to be made. So that's about efficient market. So let's look at the characteristic. We're looking at the allocative efficiency. When we're talking about allocation, remember we're talking about funds being raised. We're talking about funds being raised. When we're talking of allocation, we are looking at how companies are able to have access to the funds, how the funds are allocated to those who need it. So the market is said to be allocative efficient if it directs savings towards the most productive firms. So in an allocative efficient market, the most productive firms are the ones who have access the most to the savings or the lending and the investing that the surplus units have made. In this sense, the most efficient firms will find it easier to raise funds, and economic prosperity for the whole economy, and economic prosperity for the whole economy will be guaranteed. This is frequently referred to as invisible hand theory. So what this one is saying, that like I said, when we look at stocks that trade, the stock and the trading, you see that prices increase, prices fall. So in the efficient allocative efficiency, once everything is fair, you see that the companies whose stocks, the company who is performing better, his stocks will be priced better. So once it's priced better, it means they can sell higher. Once it's sold higher, it means it's worth that value. I hope you get it. So therefore, an investor, more investors will be attracted to that security or that share. For instance, let's say we're talking about shares. More investors will be attracted to that one. So therefore, by they being productive and their productivity reflecting in their share prices, they are able to raise more money because they attract more. I hope you are getting it. That's the allocative efficiency. But then where the a company that is not performing well and its shares are rather reflecting higher prices, like a company that is performing well, you see that the unproductive company is now having access to more funds because investors will be attracted to it. Are we guessing it? Allocative efficiency. Now we are looking at operational efficiency. Sorry. For the market to be seen as efficient, transaction costs should be as low as possible so as to be affordable to participants. So operational efficiency means that it shouldn't cost too much to be able to secure the funds. It shouldn't cost so much. The transaction cost shouldn't be too much, because once the costs are too much, and by the time you are subtracting your transaction cost from the amount you've been able to raise, what is left will not even be enough to fund the purpose for which you are raising the funds. Then that is not an efficient market. Then information processing efficiency. This shows the extent to which information regarding future prospects of a security is reflected in its current price. If all known information is reflecting in pricing, then investment becomes a fair game. So over here is saying that the price should reflect the information, even regarding the future prospects. So the price, looking at the price, the price and the information should go hand in hand. And not just information of now, but information of the prospects, information of the future, information of how well that instrument will perform in the future. That information should be reflected in the price. So now, if all known information is reflected in pricing, then investment become a fair game, because by looking at the price, the investors can make judgment. But where the price does not reflect the information, it means one now has to go and look for more information aside what the price suggests, and it's not fair. It means the one who doesn't go and look for more information will be at a loss. I hope you are getting it. Now, looking at the levels of market efficiency, we have the weak form, semi-strong form, and then the strong form. With the weak form, the share prices fully reflect historic information. So it's looking at past data. It's about the past. So that's weak, because you know that when it comes to the financial market, when it comes to stocks, when it comes to these trading activities, there are always changes. There are changes here and there. So if the price is reflecting past information or historic information, that is weak. Price movements are therefore random. Hence, the weak form is frequently referred to as random walk hypothesis. So that means that there's a lapse of time before the price will reflect historic data or historic information. So it means that price can randomly rise and we won't understand. You get it? Because the price now was reflecting past or historic information about that security. You get it? And then before you realize, in some time, the price just changes, because it's now reflecting the time that passed between when it changed till now. I hope you get. So the price can just change randomly. You may not see it coming. You get it? But if it was like the other forms where it is current, you can see a trend. So it's not just a rise and a fall random like that. So that's the weak form. Then the semi-strong form state that the current price reflects both historic and publicly available information about the company. So the information available currently, and then the historic is what the price reflects. Examining the way in which the market reacts to new information about the company can test this hypothesis. Any publicly available information would have been captured in the current share price. So now we are looking at the current information about the security or the share, and then the past. And then we're looking at the strong form. Strong form state that current share price reflects historic, public, and obviously the private information. So with the semi-strong, it is showing the current information, all right, but it is what has been made publicly available by the one who is trading the security. But then with the strong form, even the private ones that that the public do not have access to, the ones who are the how will I say it? The price still reflects those private information. So the price change rapidly and accurately to the new information. In this case, it will not be possible to make profit by dealing in response to insider information because there are rapid changes. That's the strong form. Please, are we understanding? Efficient market hypothesis. We're looking at how, in efficient markets, we're looking at how prices reflect the information or the true value of the security. That's efficiency. So in a very efficient market, considering what we've considered, in a very efficient market, if a share is 7 cedis, that 7 cedis reflects what has happened and what is actually happening with regards to the security. That's how we determine market efficiency. It's relating price with information. I think that is simple and short. Market efficiency is looking at the price and the information. Sorry, price and information. Is price reflecting the information? That's the question to be answered in determining how efficient the market is. Is price determined or reflecting the information about the security? On to another aspect. We're moving to aspect of our question then. And within the next 30 minutes, we'll look at the Islamic finance. Senior Francis, is everything okay with the financial markets from the beginning up to this point? Financial markets. Any confusion, anything to be cleared before we move on to Islamic finance?
No, sir. Sir, everything is okay.
Everything is okay.
I think that this afternoon I was learning IAS 13.
Okay.
And there was something about it concerning market efficiency. So I was also trying to relate it. So at this point, I think I'm okay.
That's good. You're taking financial reports now.
Yes, sir.
That's good. That's good. Okay. All right. Islamic finance. Islamic finance. Now, with all the finance we've been looking at, Islamic finance is another, should I say, shade, or it's another side of finance which is based on the Islamic faith, on Islamic principles, Islamic laws, and Islamic practices. That's what you are come to look at. You are come to look at how Islam, per per their practices, per the laws of Islam, of the Islam faith, how finance should be done according to Islam. So Islamic finance refers to the means by which entities in the Muslim world, including banks, lending institutions, and players in the financial market, raise capital in accordance with the Islamic Sharia law. That's the basis. The Islamic Sharia law. It becomes the regulation, becomes the reference point for which those in the Muslim world, that's the banks, the Muslim world, lending institution, and the other players or participants in the financial markets on that side, how they raise capital, and it's in accordance with the Sharia law. So that law is derived from the Quran and the teachings of the Prophet Muhammad. So it's believed that it covers all aspects of life and divine path for mankind, mapping out the norms and behavior man must follow to spiritual and physical well-being. So Islamic finance is telling us that Islam can be done in a religious way. There's a religious side to it, which shouldn't be neglected. So you're going to look at the principles. They're saying wealth must be from legitimate trade and be an asset-based investment. From legitimate trade, you work for the money, and not just any work, but legitimate work, legal work. Investment should have a social and ethical benefit to a wider society beyond pure return. And lastly, risks should be shared. Not only one person should have the risks. The risks should be shared. We all share the risks. We don't try to push the risk on one person. I hope you get it. If maybe a security is now risky, you share the risk with someone. You don't find ways per Islamic finance, per the laws that is followed. You don't quickly find a way to shift that risk to someone else or to quickly sell it to someone else. No, that goes against the faith, the how Islam faith prescribes that finance should be carried out. So also harmful activity should be avoided. Harmful activity should be avoided. Once it's harmful, there is nothing like the end justifies the means. Once it's harmful, no matter how profitable, it should be avoided. That's Islamic finance. So more specifically, there are certain things that are prohibited. Charging and receiving of interest and money, the use of money to make money. The two are related. Where you give money, charge interest on it to get money. So they don't charge interest. They don't see why you should charge interest. You give money and you want to make money on that money. Islamic finance is saying that it is prohibited. That's what they call haram. It's a haram. Charging and receiving of interest. You shouldn't receive interest on lending money. Transactions of uncertainty and involving extreme risk, such as gambling, futures, and options. So when there's extreme risk associated with the transaction, extreme uncertainties, the Islamic finance doesn't deal with that. Already, it is telling you that what? Do not charge interest. So if now the thing is risky and you can't charge interest, how are you compensated for the risk? So it makes sense that said transactions are not allowed or are prohibited. Investments in companies with high level of gearing, where a company borrows too much, where companies borrow too much, it's also not allowed. A company, because it is seen that that company is trying to take advantage of the fact that charging of interest is not allowed. Because charging of interest is not allowed, companies now decide to take a lot of loans. You get it? So because of that, investing in high level of companies that have high level of gearing is prohibited, because such companies are taking advantage of the no interest law or principle to be amassing more capital for themselves, because they know they are not going to pay interest on it. A company with a third of its market value financed by debt over the past 12 months is considered unsuitable for investment in business involved in alcohol, gambling, such businesses that bring about social vices like alcohol and gambling are not allowed, are prohibited in Islamic finance. Now we're going to look at the Islamic finance contracts. We're looking at various contracts under Islamic finance. So we are going to introduce to some terms. We're going to introduce to some terms. We have the mudaraba, which is like a partnership contract. We have the musharaka, a form of equity where partnership exists and profits and losses are shared. Murabaha, so like a credit sale. Ijara is like a lease, and sukuk is like a bond. It's a bond, like a financial instrument, a debt. Remember, we said bond means debt. Okay, let's look into details. Murabaha. What is Murabaha? We already established that it is like a partnership contract. Like a partnership contract. Let's look at how the partnership plays out. It's not like partnership as we know, like 2 to 20 people. Let's see how the partnership plays out. It's a form of trade credit or loan for asset acquisition that avoids the payment of interest. So it avoids an asset. Remember, we said that under the principles, we mentioned that wealth generation must be from legitimate trade and must be an asset-based investment. Asset-based investment. So it's a form of trade or credit. A form of trade credit or loan for asset acquisition that avoids the payment of interest. Instead, the bank buys the item and then sells it onto the customer on a deferred basis at a price that includes an agreed markup for profit. So now the bank, instead of giving loan to the business to go and buy, they rather enter into a form of agreement, which over here we are looking at, it says like a partnership, where the bank will now buy the asset. So the bank will buy the car and then give it to the company. And then with this agreement, they don't charge interest, which will be compounding, but then they agree at a marked up profit. So the car was bought for maybe 1 million, and they agree at a marked up profit of, let's say, one of let's say 50,000 or 20,000. So that 20,000 is added to. It's almost like principal plus interest. But in this case, we know that interest would have been compounded. Most financial institutions do with compound interest. So now the interest would have been compounding. But in this case, it's an agreed markup profit. So you're paying that agreed markup profit. So the payments can be made by installment. The bank is thus exposed to business risks because if the customer does not take the goods, no increase in the markup is allowed, and the goods belonging to the bank might fall in value. So with this one, it's not like the bank will always wait for companies to come before they enter into such an agreement. It is something that is being run by the banks. I hope you get it. So the banks buy assets that companies may need. And then when the companies come and where they would have, in another setting, taken a loan to go and buy the assets, they rather get the assets from the bank and then pay an installment. So it's a form of business the banks do. So instead of giving out a loan, they give out the assets. It's almost like high purchase. But then at this one, a marked up profit is agreed, and then interest is not charged. Interest is not compounded. That agreed marked up profit is what is paid. It could be paid outright or could be paid in installment, just like any other loan. That's murabaha. Any questions on that?
Hello, sir.
Murabaha. Yeah.
You said it's a form of loan
It's a
for
form of
asset
loan. Yeah.
acquisition that avoids the payment of interest. Hello.
Yeah. Yeah, I'm with you.
So it avoids the payment of interest, right?
Yes, sir.
So if the loan goes bad, what happens?
So over here, that's why we said that the bank is exposing itself to business risk. That's where no one counts for the assets. But then where one counts for the assets and defaults in paying, I think the bank has a right to take back the assets. Just like in a high purchase, you are paying for the assets, but it's not yours, and you are using it. If you default, the bank or the one who sold the asset to you on credit has every right to come for it because it's not yet yours. I hope you are getting it.
Yes, sir. So again, how will the bank be able to make profit so that
Okay.
it will be able to? Hello.
Yeah, I'm with you.
So I'm asking that in this case, how will the bank be able to make profit so that it will be able to pay its employees
All right.
and
So
other expenses?
we stated that with this one, the fact that they're not charging interest doesn't mean they don't get anything on it. But in this case, the interest doesn't compound like in a normal setting where interest compounds per annum or yeah, months. No, I think it's normally per annum. Yeah. So in this case, an agreed markup is made that okay, for example, I made an example that if the asset was 1 million and then the agreed markup, which is the profit of 20,000, is put on the 1 million, that is it. That the amount to be paid now becomes 1,020,000 Ghana cedis. You get it? But then with a normal setting, this interest compounds. Okay, so if you look at compounding interest, you see that the principal amount changes. So in year one, if it was 1,000 cedis, that's, let's say 10% was charged on. In the next year, it will become 10,000 plus the 10%, which is now 1,100 times 10%. Are you getting it? So the normal interest is supposed to be compounding, but for this one, there's a markup profit and it's fixed. It's fixed. It doesn't compound. Please, are you getting it?
Okay.
So it's more or less a way of saying maybe simple interest. Instead of them charging compounding interest, they more or less charge something like a simple interest, which is charged once. You know, simple interest,
Okay.
it is charged. You multiply everything times the time and everything, and then you put it there. But this in here, they are calling it a markup profit, and it's fixed. It
Okay.
doesn't compound like in the normal setting. So that's Murabaha, which is a form of credit sale. Okay, let's go to Ijara. It's a lease finance agreement whereby the bank buys an item for a customer and then leases it over a period at an agreed amount. Ownership of the asset remains with the bank, regardless of operating or finance transaction. Regardless of operating or finance transaction, that's the very key thing, which will seek to recover the capital cost of the equipment plus the profit margin out of the rentals pay up. So in the normal setting, once it is an operating lease, then operating lease is where the lessor or the lessor, in this case the bank, in this case we are saying is the bank, will lease it out to the entity who is leasing it, and they will retain the ownership. The bank retains the ownership but receive rental payments. It's usually for a period of time. You get it? But then finance lease is where it's more like the bank for finance lease in a normal setting. For finance lease, the one who is leasing out, or the lessor gives it to the lessee, and then the lessee becomes the owner, because in this contract it's for a long term. So that long term covers all or almost all the useful life of the asset. So it's more like it's being sold to the client or the one who is leasing it. It's more like it's being sold. So in that case, the ownership is not being retained by the one leasing it out. It's being retained by the one who is come to lease and use it. That person now becomes the owner and will still be paying rentals. But this one is more like over the whole life. So the ownership, maintenance cost, and all those things is on the lessee. But in this case, it's saying that whether it is operating or it is finance, the Ijara is saying that the ownership remains with the bank. The bank is responsible for maintenance, and the bank is legally the ones who still owns it and is giving for rental payments, which the rental payments, of course, will include a profit. Will include a profit. Sorry. And then with this one, you see that when you are when you are doing lease, I think some of us are doing FRA. So when you are doing lease, the lease liability changes. You see that what you pay the first year plus some effective interest will be different from what you pay the next year. It will be different from the liability the next year. So it adds up together to the total lease liability. In this case, it's just a fixed markup profit margin, and then that is it. That is done. And then that one will be recovered through the rental payment. That's Ijara. Ijara is a form of lease. It's a form of lease. So this one is under the for this one under the Islamic finance. It's a source of funds for assets. For assets. Any question on Ijara? Ijara or Ijara? So you see that all these ones, they are similar to something we already know, like the Murabaha is like a credit sale. The Ijara is like a lease. Just that there's just a slight change in the terms, and the emphasis is that we do not, or Islamic finance does not allow profit. Does not allow profit. Though, of course, the bank will not run at a loss or shouldn't run at a loss. They can get something on it, but then we don't want interest. Sorry, not interest. Sorry, interest. Interest. Interest is what is not prohibited, as we saw in the principle. All right, let's move on to Mudaraba, which is the partnership. Mudaraba is essentially like equity finance in which the bank and the customer share any profit. Sorry, it's essentially like equity finance in which the bank and the customer share any profit. The bank will provide the capital, and the borrower, using their expertise and knowledge, will invest that capital. So the bank provides the capital to the business. It's almost like the bank is buying the company or the borrower shares. It's more like that's why I say it's like equity finance. So the bank is giving that money to the borrower, but this time it's not being given as a debt for which principal plus interest should be paid. But then the borrower now works with the money, just like how a company having raised share capital will now work with the money to give dividends. So the same way the bank provides the capital, the borrower using their expertise and knowledge will invest that capital. Profits will be shared according to the finance agreement. No dividends are paid. So this one, profits are shared, not dividends paid. So as you can see, it's similar, just that they try uh, to ensure that those interest, dividend, those things like giving and expecting something on top of what you've given is sort of prohibited. You get it, but then it doesn't mean you run at a loss. So profit is expected and all. But then where it's not about working, but it's about just using money to make money. Remember, we said that in the principles, using money to make money is prohibited. So that is what is so you see that there's that thin line between using money to make money and then using money to work to make money. They try to cut it. So this one they're saying it's not dividend, but then the profit that from the work is now shared. You get it? So that's like the a partnership. That's like the partnership, a partnership agreement. Profits will be shared according to the finance agreement. So they have an agreement on how profit to be shared. But as with equity finance, there is no certainty that there will ever be any profit, nor is there certainty that capital will ever be recovered. So there's no certainty of profit. So as and when profit is made, then they share. And then the bank also knows that or has in mind that it's not necessarily going to recover all that money back, just like in equity finance where you buy a number of shares. As and when dividends come, you get. If the dividend is able to cover your investment, it does. You get it, but it's not guaranteed like a loan that you are sure that or guaranteed they are going to get a principal. I hope you are following. This exposes the bank to considerable investment risk as losses are solely attributable to the provider of capital. In practice, most Islamic banks use this as a I'm coming. In practice, most Islamic banks use this as a form of investment product on the liability side of their statement of financial position, whereby the investor or customer, provider of capital, deposits the funds with the bank, and it is the bank that acts as an investment manager. So the bank, in this case, will rather want to turn it or do the invest, where instead of they providing the capital, they rather want others to provide the capital. They work with it, and then they share the profits with the one who came to do the deposits. I hope you get it. That's Muda Rabba. Please, are we appreciating the concept? Mr. Wisdom. I can see you joined us not long ago. Mr. Wisdom. Hello, Mr. Wisdom. Are you with us?
Hello?
Yeah, yeah, yeah. I see you just joined. Please, are you able to follow? We are looking at
Yeah,
Islamic finance.
yeah, I'm trying to cope.
You're
I'm
trying to cope.
understanding it.
So we are looking at some contracts, packages, or products under Islamic finance. We said Islamic finance is the way in which the Muslim world conduct their finance, and it's based on the Muslim laws, the laws from the Sharia and teachings from the Prophet Muhammad. So they are trying to infuse religion into the way finance is done. Okay, let's go to the sukuk. Sukuk is like Islamic bonds. So it's a debt finance which cannot bear interest. They are very particular on the interest, no interest. Typically, an issuer of the sukuk would acquire property. So an issuer of the sukuk in our in the normal sense, when somebody is issuing a bond, It means that the person is requesting for a loan. So the one who now buys the bond and holds that bond is owed an amount of money. So the sukuk, it's an issuer of the sukuk, the one who is issuing the bond instruments for somebody to buy and then more or less give him a loan, would acquire property, and the property would generally be leased to tenants to generate income. The sukuk are issued by the issuer to the sukuk holders, so bond issued to bond holders, who thereby acquire a proprietary interest in the assets of the issuer. So now the one who issued used the money that he got from the issue to buy property, which that property will now be rented out. So when that property is being rented out, the people who bought the sukuk, which is the bond, have an interest in that asset or in that property. The issuer collects the income and distributes it to the sukuk holders. So instead of paying principal plus interest, he or she is now using what he gets from the investments or the rentals from the property to pay the sukuk holders. This entitles to a share of the income generated by the assets. Most sukuk give sukuk holders ownership of the cash flows, but not of the assets themselves. This is very key. So the fact that the sukuk holder bought or purchased the sukuk from the issuer or the bond, as we are explaining, the bond from the issuer doesn't mean that he has ownership over the asset. No, he just has an interest in the cash flow, the money that arises, but not in the asset itself. The asset is for the sukuk issuer. Then lastly, we're looking at the musharaka. It's a joint venture or investment partnership between two parties. And over here, we said that what musharaka is a form of equity where a partnership exists and profits and losses are shared. So this one is a form of partnership, but let's look at how it differs from the mudaraba. It's a joint venture or investment partnership between two parties. Both parties provide capital towards the financing of projects, and both parties share the profit. So in this case, it's not like the earlier one where the bank provides the funds, but over here, both parties are providing the funds. Both parties provide capital towards the financing of projects, and both parties share the profits in agreed proportions. This allows both parties to be rewarded for their supply of capital and managerial skills. Losses would also be shared on the basis of equity originally contributed to the venture. So over here, it's also a partnership, but it's in this case both parties are bringing capital on board, compared to the mudaraba, where the bank gives the capital to the borrower, who is to use the money and then not pay dividends or not pay principal plus interest, but rather share the profits with the bank. And we saw that under that one, recoupment of the money is not assured, and it's not always assured that there will be profits. But in the musharaka, with the musharaka, both parties bring on board the capital, and then just like partnership we know. So this one is like partnership we know. They both bring the capital, and then they they work with it and then share profits. If there are losses, they share. Banks said, because both parties are closely involved with the ongoing project management, banks do not often use musharaka transactions as they prefer to be more hands-off. But the other side of it is that usually, the banks usually will not be actively involved in the investment. Therefore, they will prefer not to do this one because their hand involvement wouldn't be there. Any questions up to this point? Any questions up to this point?
Hello, sir.
Yeah, Francis.
So I want to
Yeah,
ask that.
Francis. I'm with you.
Hello.
Yeah, I'm
Uh-huh.
with you.
So does it mean that a Muslim cannot go to any ordinary bank to borrow money?
Well, as to how strictly they follow these principles, I can't really tell, especially on our side. On our side, but then I think in our definition we saw that it's the Muslim world, so I think it will be more applicable. Though I've not really searched into how practical this is, but I think if it's practical at all, it will be more applicable in maybe the Arab countries and all. But not that you as a Muslim in Ghana, the Ghanaian banks are not following Islamic finance because that's not what they work with. But then I should
Okay.
think that uh, in the Muslim countries, yeah, in the Arab countries where Islam is the the religion over there, if this is practiced, then it's over there that we'll see these things.
Oh, okay.
All right. So today we've looked at financial markets and we've looked at Islamic finance. If there are no questions up to this point, we'll end here. And then in our next meeting, we would be looking at some questions on the things we've done up to this point. So please, before our next meeting, I would want that we all have gone through the notes, and then, if possible, watch the videos too. Even if you were in the class, watch them again. And then, so that when we are solving questions, in solving of the questions, we are applying. So if your understanding of the introductions and the basics is weak, it would reflect in when we are applying to solve the questions. So as a matter of urgency, we should make sure we've gone through. So when we are solving the questions, it will be smooth and we will not be slowing each other down. All right, so we'll end here. Have a good night. We'll meet in our next meeting.
Okay, sir.